One statement, 11 words, and the global reserve currency just entered its most uncertain phase in 50 years. Former President Donald Trump said it out loud, what central bankers have whispered in private for 2 decades. The dollar's dominance isn't guaranteed. It's negotiable. And if America doesn't fix its fiscal trajectory, other nations will fix it for us by walking away. That's not speculation. That's the message Beijing, Moscow, and Riyadh heard loud and clear when Trump broke his silence on dollar policy this week. Here's what this means for your savings account, your mortgage rate, and every dollar you've got sitting in a bank right now. If the world's reserve currency loses that status, the inflation you've seen over the last 3 years becomes the warm-up act. Your purchasing power doesn't erode slowly, it collapses quickly. Because when global trade stops settling in dollars, American consumers absorb the adjustment. Every imported good gets more expensive. Every treasury bond becomes harder to sell. And the government's ability to print money without immediate consequences disappears overnight. This channel runs on no corporate funding, no government backing, and no advertising pressure telling us what to leave out. If this kind of analysis matters to you, the kind that connects Trump's statement to your financial future before mainstream outlets catch up, hit subscribe and turn on notifications. Because what happens next in currency markets will determine whether your retirement plan survives the next decade. Let me show you exactly what Trump said and why it triggered alarm bells in every major finance capital on earth. On March 28th, during a closed-door meeting with economic advisors in Palm Beach, Trump was asked about the dollar's role in global trade. His response, according to 3 people in the room who spoke to Bloomberg on condition of anonymity, the dollar is strong because the world needs it, but we're making it really easy for them to need it less. Our debt, our deficits, it's an invitation for them to build something else. 11 words in that last sentence rewrote the rules. It's an invitation for them to build something else. And no former president has ever described dollar dominance as conditional, as temporary, as something America could lose through fiscal recklessness rather than military defeat. Trump just did. And he said it the same week that Saudi Arabia confirmed it would accept Chinese yuan for 15% of its oil sales to Beijing, a threshold that seemed impossible 3 years ago. Now here's where the official narrative and the operational reality split apart. The Federal Reserve released a statement within 6 hours, carefully worded, completely safe. It said the dollar's reserve status is supported by deep capital markets, rule of law, and the full faith and credit of the United States government. All true, all irrelevant to what's actually happening in global finance right now, because the Fed's statement addresses why the dollar became the reserve currency. Trump's comment addresses why it might not stay that way. The difference is everything. Let me break down what Trump knows that the Fed won't acknowledge publicly. The United States federal debt currently sits at $34.6 trillion. Annual deficits are running at $1.7 trillion. That's 3% of GDP, a deficit level historically reserved for wartime or severe recession. Except we're in neither. The economy is growing, unemployment is below 4%, and Washington is still spending like the printing press has no consequences. Here's the technical problem that makes Trump's warning so precise. When you run trillion-dollar deficits, someone has to buy the bonds. For 70 years, foreign central banks lined up to buy U.S. treasuries because they needed dollars to settle international trade. Oil priced in dollars, commodities priced in dollars, shipping contracts priced in dollars. If you wanted to participate in the global economy, you needed a reserve of U.S. currency. So you bought treasury bonds. You funded America's deficit spending. And Washington got to borrow at artificially low rates because demand for treasuries was structural, not based on the quality of U.S. fiscal policy, but on the mechanics of the trade system. That structural demand is breaking, and Trump just acknowledged it's breaking because America made it break. Saudi Arabia's yuan oil sales are the visible symptom. The deeper disease is what's happening in central bank reserve management. According to the International Monetary Fund, the dollar's share of global reserves has dropped from 71% in 1999 to 58% in 2024, a 13 percentage point decline over 25 years. That sounds gradual. It's not. Half of that decline happened in the last 6 years. The pace is accelerating. And it's accelerating because nations are actively building alternatives, not just passively diversifying. Here's what they're not telling you in the mainstream coverage of Trump's comments. This isn't about Trump versus Biden fiscal policy. Both administrations exploded the deficit. Trump added $4 trillion to the national debt in 4 years. Biden is on track to add $5 trillion in his first term. The problem is bipartisan. The spending is bipartisan. And the consequences, when they arrive, will be bipartisan too. What Trump did this week was break the silence. He said what every sovereign wealth fund manager and every foreign finance minister already knows. America's fiscal policy is forcing the world to build a post-dollar system, not because they want to, because they have to. Because you can't hold 60% of your national reserves in a currency issued by a government that adds $7 trillion in debt every single year with no plan to stop. Let me show you the math that explains why Trump's comment triggered such an immediate response in financial markets. The United States government currently pays approximately $880 billion per year in interest on the national debt. That's more than the defense budget, more than Medicare. It's the third largest line item in the federal budget, and it's growing. As older bonds mature and get refinanced at higher interest rates, that $880 billion is projected to hit $4 trillion by 2034. At that point, interest payments alone will consume nearly 20% of all federal revenue. Here's the asymmetry that matters. When the dollar was the unchallenged reserve currency, the U.S. could issue debt at 2% to 3% interest rates because demand was guaranteed. Now that reserve status is eroding. Competition exists. If China offers Belt and Road financing in yuan, if the BRICS nations develop a settlement currency, if Saudi Arabia prices oil in multiple currencies, then U.S. treasuries have to compete on fundamentals. And the fundamentals are brutal. 120% debt to GDP ratio, chronic deficits, no political will to cut spending. If treasury yields have to rise to 6% or 7% to attract buyers without the reserve currency premium, the interest cost doesn't just increase, it explodes. At 6% average rates across the debt stock, annual interest payments would exceed $2 trillion. That's larger than Social Security. At that point, the government faces an impossible choice: cut entitlements, raise taxes to economy-killing levels, or print money and trigger inflation. Every option is painful. And Trump just told the world that America is aware this cliff exists, but has no intention of stepping back from it. Now let me show you the number almost nobody is discussing, and it reveals more about dollar vulnerability than any official statement. In 2000, 90% of international transactions settled in dollars. As of the first quarter of 2024, that figure sits at 54%. In 24 years, the dollar lost 36 percentage points of transaction dominance, and 18 of those 36 points disappeared in the last 5 years. Read that again slowly. Half of the dollar's decline in transaction share happened in 1/5 of the time period. The trend isn't linear, it's exponential. And exponential trends don't give you decades to adjust. They give you years, maybe less. Here's where this connects to the bigger geopolitical pattern Trump was signaling. China has spent the last decade building the infrastructure for a post-dollar world, not theoretically, operationally. The Cross-Border Interbank Payment System, CIPS, is China's alternative to SWIFT. It launched in 2015. By 2024, it processes over $80 billion in daily transactions. That's not a pilot program. That's a functioning parallel financial architecture. It handles trade settlement between 1,400 financial institutions across 109 countries. When the United States froze Russian central bank assets in 2022, every nation watching drew the same conclusion. Dollar reserves are not actually reserves if Washington can seize them for geopolitical reasons. The BRICS nations, Brazil, Russia, India, China, South Africa, are now actively developing a common settlement currency, not to replace the dollar everywhere, to replace it where it matters most, in commodity trade, energy trade, and infrastructure financing. Saudi Arabia, the UAE, Egypt, and Iran have all either joined BRICS or applied for membership. Combined, these nations represent 46% of the global population and 37% of global GDP. If they develop a credible settlement mechanism that bypasses the dollar for oil, minerals, and manufactured goods, the structural demand for U.S. treasuries evaporates. And that's the invitation Trump referenced. Every trillion-dollar deficit is an invitation for the world to build something else. Every debt ceiling crisis is an invitation. Every political standoff that threatens government shutdown is an invitation, because stability is the only thing reserve currency status actually requires, and the United States is advertising its instability to every central bank on Earth. Russia is watching this with the satisfaction of a chess player whose opponent just blundered into a forced sequence. Moscow doesn't need to defeat the dollar militarily. It just needs to wait for Washington to defeat the dollar fiscally. Every month that U.S. debt grows faster than GDP, every quarter that deficits remain above 5% during an expansion, Russia gains leverage passively without acting. Because the dollar's erosion weakens American sanctions, reduces the cost of being cut off from SWIFT, and makes alternative payment systems more viable for nations that want to trade with Moscow despite Western pressure. China's strategic calculation is even clearer. Beijing holds $775 billion in U.S. treasuries. That sounds like leverage for Washington. China needs us to stay solvent. The reality is the opposite. China is slowly, methodically reducing its treasury holdings while building yuan-denominated commodity markets, currency swap agreements, and trade finance systems. At the same time, China is accumulating physical gold at a record pace, adding 225 tons to its reserves in 2023 alone. That's the central bank equivalent of packing a go bag. You don't accumulate gold at that rate if you believe the current reserve system is stable. The message transmitting to governments across the developing world is not subtle. Reserve currency status is not permanent. It's earned daily through fiscal discipline, monetary credibility, and political stability. And America is demonstrating none of those qualities right now. A nation that invests in yuan access, CIPS integration, and commodity pricing alternatives is positioning for a world where dollar dominance is optional, not mandatory. Let me pull back and show you what this means at the civilizational level, because that's where Trump's comment truly lands. For 80 years, American power rested on a simple foundation. The world needed dollars, so the world funded American deficits. That allowed the United States to maintain a global military presence, run trade deficits without currency collapse, and borrow at rates no other nation could access. It was an extraordinary privilege. And Trump just acknowledged that privilege is ending, not because of foreign aggression, but because of domestic fiscal irresponsibility. What burned in currency markets this week when Trump's comments leaked is not panic. It's recognition. Recognition that even America's political leadership understands the math has turned against us. And when the people running the system admit the system is breaking, everyone else starts building lifeboats. Here are my 3 predictions with a clock attached. First, within the next 18 months, at least one major commodity, copper or natural gas, will start pricing contracts in yuan alongside dollar pricing. Not instead of, alongside. That dual pricing model becomes the transition mechanism. Second, by the end of 2025, BRICS nations will announce a trade settlement framework that processes at least $100 billion annually in non-dollar transactions. The infrastructure is already being built. The announcement is just formalization. Third, within 36 months, U.S. Treasury auctions will experience their first failed auction, where demand at the announced yield is insufficient to clear the offered bonds. The Fed will step in to buy the shortfall, and that moment will mark the visible beginning of dollar endgame. Trump's statement this week was not a policy announcement. It was acknowledgement of reality. The question is no longer whether the dollar's reserve status will erode. The question is how fast, how disruptively, and whether American institutions can adapt before the adjustment becomes a crisis. Now, here's what you need to understand about your personal financial position in this environment. If the dollar loses reserve status gradually over 20 years, that's manageable. Inflation runs higher than historical norms. Interest rates stay elevated, but the system adapts. If the transition happens rapidly, if a major treasury auction fails, if oil markets abandon dollar pricing, if a debt ceiling standoff triggers a technical default, then you're looking at currency crisis. And in a currency crisis, cash becomes a liability, not an asset, because the government's instinct will be to inflate away the debt, print money, devalue the currency, and every dollar in your savings account loses purchasing power by the day. The strategy that protects you in this scenario is the same strategy central banks are already executing. Diversify out of pure dollar exposure. That doesn't mean sell everything and buy gold bars. It means hold assets that maintain value regardless of currency regime. Real estate, productive businesses, commodities, inflation-protected securities, anything that can't be printed into irrelevance. What Trump did this week was remove the veil. He said plainly what the data has been showing for 5 years. The dollar's dominance is optional, and America is making it easy for the world to choose otherwise. Drop your prediction in the comments. Which happens first, the yuan commodity contract, the BRICS settlement framework, or the failed treasury auction? Tell me, because I read every single one, and the people in this community are seeing what's coming before the mainstream catches up. If this gave you something the financial media didn't, a framework for understanding what Trump's comment actually means and why it matters to your money, Share this with one person who needs to understand what's happening before the adjustment begins. Because once the transition accelerates, most people will realize too late that the rules changed while they weren't paying attention. The next video goes somewhere even this one didn't reach. It's about what happens when central banks stop trusting each other. Subscribe so you're there when it lands.